This is Megan Horneman, the Chief Investment Officer for Verdence Capital Advisors. We're coming to you today with our regular segment of Markets with Megan. It's Friday, February 2nd, and today we got the January employment report. So this has been one of the most anticipated economic data pieces that we've gotten this week. And I did not see this coming, and I'm not alone on this. This report blew away the expectations. The U.S. economy added 353,000 jobs in January. The highest estimate that was out there for the economists that are polled by Bloomberg was 300,000. So this was a blockbuster report. When you look at the headline, this is not something that's abnormal for January. Let's just keep that in mind. There is some seasonal noise in January reports, but we can't deny that backward-looking 2 months, we got another 126,000 net revisions positive for job creation. Now let's dig into this report. The jobs that were created were primarily focused in the private education and healthcare, also professional business services, as well as trade and transportation. Another good thing out of this report was women led the increase. So this was an area that we focused on, which was a structural issue after the pandemic, women coming back into the labor force, and we're seeing them come back, and the hiring has been strong. So all of the age groups were up, and they were about 198,000 of those jobs. Now, what's the Fed going to look at? Again, good report, solid report. We really can't pick apart too many negatives in this report. The unemployment rate stayed about 3.7%, but the Fed's going to be looking at a couple things. First of all, the average hourly earnings, they did tick up to 4.5% on a year-over-year basis. This was a 0.6% jump. That's a big jump in wages. This is something the Fed's going to focus on. This is also why we've seen the expectation for a March rate cut basically off the table. One of the other things that we look at as a leading indicator for jobs, though, and again, this is a 1 month report, so we'll see if this continues to be a trend, but the average hours worked by employees. This is something that has historically been a leading indicator for the labor market, because if you're reducing the amount of hours that your employees work, you do that first before you then ultimately do layoffs. We saw this fall pretty precipitously, actually. This is now the lowest level that we've seen since March of 2020, when the pandemic shut down the world. We also saw the underemployment rate. So this is people that want to work full-time but are working part-time because of economic reasons. That did tick up by a tenth as well. So good report. We can't really put too many holes in this. Obviously, the market's reacting with the bond yields are higher because the Fed rate cuts are being pushed out into later this year. Equities have turned around on this. The initial reaction was for equities to go lower, but from some earnings perspective and individual company news that we got this week, we're seeing the markets actually marginally higher now as we end this week. That's all we have for today. If you have any questions or comments, please reach out to podcast@verdence.com. Thank you.